Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 11th, 2016. This video will be a wrap up to last week's trading. Actually, something I started working on over the weekend. I ran into some issues. I recently, over the holidays, upgraded my main trading PC to Windows 10 after doing 4 other computers in the house with no problems months ago, beta testing those, letting it work. Anyways, I won't go into details, but I had lost when I started to put this update together. I realized I had to revert to an old hard drive, a backup drive, and in doing so, I didn't have the screen capture software functioning on that drive. So now I'm up to speed. Everything's been morphed over, migrated over. All my data, my backups have been moved over to my backup hard drive, and I've got the programs working. So here we go. We'll dive into the charts. Well, let's just summarize what happened last week. Last week, that was a pretty bad week for the markets. The S&P was down 6.13%, Nasdaq down about 7.25%, and that's over the first week of the year so far. So not only have we not seen the January effect. For those of you not familiar, January effect is typically January is a very positive year. A positive month in the markets. Historically, it has been. Then again, we didn't get the Santa Claus rally either. That's something else that people were expecting and often do. Now, I've stated this before. Seasonality is great. Yes, more often than not, the markets do rise in December and especially in January. But in this case, the charts didn't confirm that. And charts, to me, come first. Seasonality, if the charts confirm the move in seasonality, or the charts are even ambiguous. In other words, if it's a coin toss, sometimes I look at the charts and I don't have an opinion. I can't make heads or tails of it. And if that's the case, then the bias, you would have to then put a heavier weighting on the seasonality. Personally, I mean, I don't trade. If I have to flip a coin, I'll just stay out of the market. But as a trader, if the charts confirm, I'm in. If they tell me to be long, I'm long. If they tell me to be short, I'm short. And if I can't make heads or tails of the charts, I'll sit in cash. Don't ever try to force trading. That's a sure way to rack up losses. So here's where we're at. I've gone over this chart quite a bit in static form. I posted this throughout last week. And this is just, again, a great example of how well technicals tend to work, especially in sell-offs or during impulsive moves. So we had back when we were in this trading range, I had these 3 targets listed. We gapped below the trading range, came back tested the T1 level, which was former support, now resistance. I mentioned when we gap down that would be a very objective area to add if you weren't already short, and we had 2 opportunities there. Went down, and then you can see what happened. We gapped down the following day almost perfectly to that T2 level, and as so often is the case, the initial reaction of a support level, especially a price target, you'll notice sometimes I'll list support levels, but that's not a price target. Those are more what I refer to as minor support levels or minor resistance levels. So in this case, T2 hit it, bounced up, kissed the back of that former support level, which is then resistance, and that's where we stopped, moved down, had a second tag of the support level, bounced up. Now this is where trading can get tricky, and this is where the reason I refer to the site as right side of the chart. You have to anticipate what's going to happen to the right side of the chart, and meaning in the future. Anything to the right of the chart is what's in the future. Because if you are reactionary in trading, especially in active trading, you'll never get anywhere. You cannot react to the charts. What happened here is you gap down the next day, a big, large gap down, well below that. So in other words, if you were a technical trader and say you agreed with these levels in T2, okay, this is support, boom, we tagged it. All right, and you say to yourself, I'll wait till the next break of that level to add to my shorts or to enter a short position. Well, you didn't get that opportunity because what happened is you gapped too far below it for an objective entry. In fact, we gapped right down to my 3rd target level, almost to the penny, and as so often is the case, the initial tag of support or target level produced a reaction. That reaction fell short. It didn't give a full back test of the T2 level. And as I say, in impulsive moves, whether it's a bull run in the market and the market's in a very strong uptrend, in those cases, you typically don't get a full pullback to support. You have too many buyers that step in. And in the case of an impulsive sell-off, you're not always going to get that kiss back to resistance. In the early stages, yes, sometimes you do. But once that selling really starts to accelerate, there's too much downside momentum, and you start seeing profit taking. The longs who are trapped are trying to get out on any bounce. The shorts who missed a move are trying to get in, so they might not want to wait for a full back test. Whatever the reason, that's been my experience. So now we're getting to the point where it's not objective. This was your objective area to add on. Even back here on the initial bounce off that T2 level when you had that bounce up here. At this point, the markets are quite stretched near term. If depending, of course, on your trading style, your time horizon, longer term traders, swing traders, by all means, if you're short, stay short, lower your stops. But if you don't have any short positions at this time, it is, in my opinion, not an objective time to add, at least not aggressively. Maybe scale in at the very most, again, depending on your time horizon. But again, you can see once that level, we had that bounce, broke that T3 support level, came and back tested from below several times. So the market failed. We had one little candlestick wick here. See the shadow that comes up, meaning we never got to close above that level. So you can just see how well, once again, these support and resistance levels have worked. Now I've gone ahead and added a few more levels. Did this last week, and I don't know if I got the chart out. I did this on Friday. These are the next support levels that I have here. 104.21, roughly in black. 102.21. So we'll call it 102.20. These aren't exact. I just put the lines where I saw there's a nice gap. There's some, actually quite a bit of, this is a decent support level. And that's where the markets are currently trading, right around. Next support 102.20, and then this is the critical support down here. The critical support, if we go back to the August meltdown, we had that long shadow or candlestick tail, and I mentioned before, I almost disregard that. Yes, those trades happened, but the Qs had there was a sort of a mini crash in a lot of securities, including the Qs. So this happened briefly, within seconds, or within a minute or two, we were back above that level. And I went over this at the time. On that day, most of the trades occurred around this level, around the 98 to 98.50 level, and that's where we came back tested again on October. So again, I disregard the spike. Yes, did it happen? But a few errant trades just due to the huge spreads at the open, the liquidity void there. We had a couple fills that came way down below, especially in the Qs. This doesn't match what happened in the NDX, nor a lot of the other major indices like the S&P 500. So that's the support I'm looking at there. And I do expect, I'll be clear, I do expect a continued move down here. Again, we're halfway between the major resistance at this point is the bottom of this multi-month trading zone or consolidation zone. So call it, roughly the 109.70 area right there. That's going to be our key resistance, and this is our critical support. And we're right in the middle. That's, again, why it might not be objective to add at this point or aggressively add. Maybe your long trail your stops down. If you want to scale in, that's fine. If you were to short here, just put a stop where if we do get one of those sharp snapback oversold rallies and go all the way up here, that's a pretty big move. If you entered here to allow your stops all the way back up to 109.70. Again, it depends where your targets are. I do expect over time that this critical support level gets taken out. That's my current expectation, but we may most likely get a reaction if we get there. So that's something to consider. Now, longer term investors, if you're trend trading, because we do have all the short term trend indicators are currently bearish. The most intermediate term trends are bearish, and some of the long-term trend indicators have even moved over to bearish. Depends on which ones. There's still a few, little work to be done on the long-term side with the trend indicators to really confirm that the trend is down. And I'm talking my weekly and monthly trend indicators. So if we get that, and if we move down to this critical support level, especially if we close down here by month end, or close below that, then we'll almost certainly have those trend indicators bearish. Now, what I'm getting at here is a longer-term trader or investor who is short the Qs. We've had TQQ on the site as an active short for a while, and I mentioned these as just initial targets, these 60-minute chart targets. And I haven't even finalized any of the longer-term targets because I plan that to be a multi-month swing short trade. So even myself personally, I wear two hats. I'm an active trader. I have a trading account where I will at times game these levels by gaming those. I'm talking about micromanaging, cover the initial tag of support, trade a bounce, re-short, go long. When I say cover or reverse, go long. Now I haven't done it on each and every one of these. It just depends on really what I have going on at the time, how much focus I can put on the charts, if the charts confirm, where I expect a reaction. But as you can see, in just about every case, you could have, even for a day trade, a quick scalp, closed your shorts, reversed, and gone long. And these are the levels that I'm watching now. Now, I also have IRA accounts, SEPs, 401ks, all types of other, retirement accounts, both my personally and family accounts. And in those, I'm not an active trader. You can't trade actively because of the rules that apply as far as how many trades you can do and what do they call it, free riding and things like that. So you have to swing trade. In that case, what my plan is with the TQQ, if and when we get there, I don't plan on covering. I should take that back. It depends on the charts. If I see strong bullish divergence on at least a 60-minute time frame, maybe the 30-minute time frame, as the Qs approach this level, this critical support at about 98.50 to 98, and again, assuming we get there, then at that point, it's possible that I cover and wait for a break to reshort. But more than likely, what I'll do with the long-term trades is, as we get there, I will lower my stops. That'll be determined at the time, probably no more than this 104-ish area, maybe a little bit lower, because I would expect a break. Remember, we've already had 1-2 tags at that level. It's usually, from my experience, the third tag. That's usually, if you're going to get a break, it's on the third or right after the third tag. Here you can see 1, 2, 3, and then boom, we gapped down. It never even saw a third tag. We gapped right below it. So that would be my expectation. And that also meshes with where I think we are. If you watched my, U.S. equity market video recently, where I expect or believe that we are in this sell-off, and that is where you have the most impulsive selling. Pretty much it could be for those Elliottians, the big P3, the primary third wave down in a bear market. We'll see. But either way, so far the selling has been impulsive, and whether you subscribe to Elliott wave theory or you don't, or don't even know what it is, all we can say with certainty is right now we are seeing impulsive selling. These rips, the bounces are getting sold into quickly. Support levels are being taken out one after another. So the trend is clearly bearish, and you want to trade accordingly. Okay, that's enough on the broad markets, or the equity markets. I'm just going to go through a few sectors here real quick. GDX is one that I've been bullish on, heading into the holidays, and I've had this, actually been along on the site, I believe, and we have a target of, this one I've been calling for since, I guess, December, maybe November, this 1510 area. And I've done a few updates in the trading room because people have asked the questions. There's not a whole lot that has changed in the charts of gold or GDX, but the charts remain constructive at this time. So we had, the initial move up. I don't see anything here on the charts to tell me, my trend indicators are bullish right now. I don't see any divergence here on the 60-minute frame to be concerned about. And here's a trend line I've drawn. I'm not putting too much weighting. GDX is a tricky little sucker to trade at times. It tends to move in and out, just take out these trend lines. I had a downtrend line here. We slightly took it out. We back tested it for a while and then moved back up. Something to watch, but I would be more concerned with a break below this level. I mentioned in the trading room the other day, I believe it was around the 1420-ish level. I said this line that I'm highlighting here, during the pullback, we went up. We had a pullback last week at the end of last week, and I mentioned that this would be another objective support level to add on to if you were currently long. And that level did hold. You can see we bounced pretty much right off that line. Now that line is defined by this reaction high. Here's a reaction high. That's 2. Reaction high here. We had another reaction high back here. So pretty decent support level. Looking really at these most recent, these 1, 2, 3 reaction highs and that gap above it. So as long as 1420 holds, we're in good shape, and I think we might continue up to that 1510. That runs all the way up about 1530, but I always set my sell targets a little bit below to help assure a fill. So there's GDX. Anyways, I still, like I said, think the charts look constructive. Not sure if I'd be at least adding aggressively here if you're not already long, but I did want to update that trade for those of you that are trading the miners long right now. Okay, a couple other sectors to note. I wanted to just wrap this up by going through a few sectors here. XRT, this broke down on last week. Nice breakdown. You can see this trend line going all the way back. This is a 2-day period chart, so it's like a daily chart, except every candlestick represents 2 days price action. It goes back 4 years. And here's a very nicely defined trend line. 1, 2, almost 3 there, 4, 5 tags, and then boom, a breakdown. So now that's the retail sector. There's quite a few retail stocks that I'm looking at, and we'll get into that. And we recently closed Walmart long. We got a nice bounce off Walmart. Here's Amazon, one of the biggest stock in the XRT. And you can see, look at this well-defined trend line off the early 2015 lows back in January. Big rising wedge pattern, and Amazon's just now cracking below that. So Amazon has this gap to contend with below, and that's why I wouldn't short a break of this trend line. Normally, if I didn't have this gap support here, we have that reaction high, nice gap there. So to be safe, if you were to short Amazon, which is great company, but insanely overvalued. There's call it 582. So I want to say 580, probably a daily, and to be really safe, a weekly close under 580 should send Amazon down to the 493 level. But again, this video I didn't want to do. I'll do a separate one on trade ideas. I just wanted to point out that the retail stocks have broken down, and Amazon being the largest of the group. That tells you, in my opinion, a lot right there. XAL, I put up a chart this is a weekly chart of XAL, the Amex Airline Index. I've got have a couple of either at least 1 or 2 official short trade ideas now. There's quite a few I'm watching. Again, I don't have time in this video to go through each and every the individual components. Or at least I'm considering adding some more official individual airline shorts. We have a couple on there now, but just a beautiful chart. 2009 lows there. A well-defined uptrend line, divergent high, everything I look for, breakdown, backtest, prices rolling over. Now, to really get the party started here on the airline sectors, at least on the short side, we have to take out that reaction low from back here. When was that? That was in, looks like late August. Once we get below there, we do have a reaction low at that point, but this is our next nice next support level here. And I feel pretty safe to say that the airline stocks will see that level in the coming months, and more than likely, before all is said and done, this would be my price target. This is not an exact line, but call it 52.60ish. I think before all is said and done in 2016, that's where the airline sector is going. And it's currently trading, the XALs at 78.33 right now, so you can see that'd be a pretty good drop. And again, maybe a separate video on the airline sector individual stocks, some of my top picks, or at least put those up in static format. This is XBI, the biotech sector, one of the biotech sector ETFs, and as most of you know, one of my favorites from last year. Did tremendously well shorting those into the meltdown, covering right at the lows there, making some trades long and short, and I remain bearish. I've left, even though I personally posted, or I should say that more clearly, posted personally covering my biotech shorts and going long the sector for the bounce. I left that LABU, which is the 3-time long biotech ETF. I left that intentionally on as a long-term short trade idea for those of you who are able to secure, those 3-time ETF shorts. Interactive Brokers by far has the best availability of shares to short. And there are quite a few other brokers out there I know right now have LABU available. You may have to pay a little interest to borrow it, but the decay on that thing should be and it is just vicious because of the volatility in the sector. So, and when you short the long version of an ETF, especially the 3-time, if you get the price move right, you not only get the leverage and the advantage of the price security going down, I should say, but you also have the decay working in your favor. So here's a support level right now. We're coming up on around 58.50-ish. We've already taken out those previous reaction lows. If you can see, really, if I put my cursor there, that was about 59.50. These the previous reaction lows. So it's looking pretty bearish, and I think we're going quite a bit lower in the biotechs over time. Like I said before, I think that this was just the initial wave down in a new bear market in the biotechs. Let's look at a few others. PBE, that's the best of the group. There's 3 big biotech ETFs I follow. This one has a primary uptrend line quite a bit lower. But like most, if you look at this, it appears to me that after the initial breakdown, we pretty much just had this flagging action. This is what most of the biotechs look like. So breakdown, sort of a bear flaggish action. Again, this is that, especially in PBE, we had a huge mini crash, which isn't really reflective of what the sector did because that managed to close back up that day. And so if you just mentally erase that, again, that candlestick will show like that because there were a few trades that happened to take place down here that low. But this is what's happened: breakdown, bear flag, and now we've broken down from that bear flag. And just simple TA 101. If you take the measurement here of the flagpole from the top down to the bottom of the flag, add it to the top of the flag, and that's where we project down to that level. So, and this is where I have some support here. That would be my near-term target or swing target, about 37.80 on PBE. Probably shouldn't spend too much time. That's not one of the more popular ones. IBB, you can see here, I drew the same thing, bear flag. So again, we're looking at a weekly chart, and just look how look at this uptrend line. 1, 2, 3, numerous tags, well-defined trend line. We had the breakdown. The impulsiveness of that breakdown helps confirm the breakdown. We had that bear flagging action underneath. We've broken down from that bear flag, and this would be the next key support level. Call it 278-ish right there. We also have a Fibonacci retracement level below there. So if and when that level goes, my guess is the biotechs are heading much lower. I have a support level here, 250-ish, and I think before all said and done, we'll probably go lower than that. Okay, this video is getting a little bit long. I'll just wrap up with one more sector. There's others out there, and I'll get to those. I'll put up some static charts on the site. But this is a semiconductor. This is my preferred proxy for shorting it. The SOXL, which is the 3-time bullish ETF for the semiconductor sector. We've already hit our first target. Let's see, I think I might have had this up on a 2-day chart. Yep, I did before. You can see that trend line break, back test, and we hit the first target and smash below that. And here's a good example of the impulsive nature of the sell-off. That was a pretty well-defined level, hit it, and now we've moved down, and we've been selling down pretty hard since. It's having a little counter-trend bounce. The markets are up, or at least the semis are up today. But this is the next and final downside target at this point. I'll be covering and personally covering SOXL and removing that from the trade ideas if and when we get there. But let's take a look at the semiconductors SMH. This is the one-time ETF. I must have at the same time listed targets for those of you who can't get the 3-time ETFs, or maybe your broker charges an interest rate that's too high, or you just prefer the shorting the one time. There's the targets on that. So they might not correspond. They don't correspond with SOXL, but this would be your next support level, or at least price target, which is set a little bit above the actual support, 47.87, and then ultimately $44. So I should raise that. Well, no, we have the reaction there. Usually I complete that. I'll take another look at that. I'll call it 44-ish. Again, that's not the official trade idea anyways. I just wanted to share the SMH, and let's take a look at it from the weekly chart. So here's the semis. We had this uptrend line, divergent high, bullish, bearish rising wedge pattern breakdown. Kiss that, there's a nice support level there. We moved up, failed to make new highs, have been moving down impulsively since. Remember that, again, that was marked with a divergent high like so many other sectors and indices right now. And that indicates that we're probably heading lower over. Okay, I'm just going to wrap the video up with a quick overview of the trade ideas. The completed trade ideas so far this week. I'll try to get in the habit of doing this once a week. I'd like to do an overview, and as time goes on, I'll get these a little more streamlined and a little more efficient. But last week, I updated all the trade ideas that were completed, either stopped out or hit a profit target, except one. During the holidays, as most of you know, I take the last couple weeks of the year off. I don't trade much. I was in and out of the trading room a little bit there. I made mention, if I'm not mistaken, EnLink, ENLK it's actually the only active growth and income trade at the time right now. And this was a trade we entered on December 15th. It was posted as an active trade while it was trading at, let's see, I'm looking at another screen here. $13.24. So we were right around here, $13.24. And what happened? The stock ripped up. It was good for a 20% gain, 19.9% to be exact, and that was just in a couple weeks. So we did hit not only the first but the second target, and I'm not counting to the highs. I'm just talking the gain here to T2. I never count a gain past the first target or the target level unless we happen to gap past it. If you gapped above it, then that's where your order would have filled if you had a standing sell limit order. So we did hit T2. We pulled back. Now we're back to right about entry. As I mentioned, 13.24 is where that trade was added. We're only at 13.09. For those of you still in it, remember it has a very attractive dividend yield. I think it's around 11%. Yep, 11% dividend yield. And you can see this long-term support level. Bullish divergence here on the RSI. So if you're a longer term trader, I think it still looks good. You might consider a close, solid weekly close above that level. That's $13. So I'll put up some notes on the site, but let's just say, call it solid weekly close. Let's say of under 12. I would say 12.85 to give it a little margin of error. That's a relatively minor loss compared to the gain potential. Again, I always quantify my trades on a risk return perspective. So some of you sometimes you see a trade with a 8, 10, 15% stop loss, which you might say that's crazy. Well, if the upside potential for that trade is 45, 50, 60%, that's well within an RR perspective. But what's important is that you adjust your position size accordingly. In other words, if I trade, let's say the QQQ, and let's say a normal position size is $10,000 and I'm willing to take a 5% stop loss on it, well, that's $500 loss. If I trade dust and I have to allow, because of the leverage and the volatility there, I need to allow a 15% loss. Well, I'll take a position size, maybe a third of that, $3,500 or so. In other words, a 15% loss on a one-third position size is comparable to a 5% loss on a normal position size. So you can Google the term beta adjusted position sizing on the search thing. I've written a detailed piece on that. So again, just always take your stops into account with position size on not just the percentage loss, but more importantly, the dollar loss that you're willing to take on each trade. So again, EnLink looks good. You can give it some rope if you're a longer term investor. Shorter term traders, and that's why I have multiple targets. Swing traders could have booked profits at T1 and or T2. There was a downtrend line here, which that's actually what stopped it cold. I had that downtrend line on the original chart, and you can see just how well prices have behaved off that. Again, this is just technical analysis 101. We came up and we made an intraday break, but failed to get above it. So it looks like we closed down right on it or below it, and had several other several 1, 2. There's actually the numbers there. You can see 3 other attempts to get above that trend line, and it failed. So this is why those trend lines are on that chart. Ideally, that probably should have been listed as the third target, but the reason I didn't list that as the third target at the time, I didn't expect such a quick move up. I thought that trend line, I thought T2 would come in with this trend line and this horizontal level coming in together, if the stock moved up in a more orderly or normal rate of ascent there. So either way, looks good for now, as I just showed you on the weekly chart. But I will be concerned. See, here's 1290. There's a cluster of reactions down here. So that's why I said, let's say, to be safe, longer term investors, let's say 1280. Weekly close below 1280 would be an objective stop. I wouldn't wait till we get below this reaction low. That's just a little too low. That's $12 down there. So again, I think it looks good over time. But obviously it's had a pullback to digest that strong run up, and we're back down to just below a break even on that trade if you're a buy and hold investor and haven't done anything other than that. Okay, so besides EnLink, the 2016 completed trades are pretty much what we completed last week. So Walmart hit its first target. You can go down there if you just go to the completed trade under trade ideas. All completed trades, or you can look by category. We had one trade stopped out last week, KHC, and it may actually have been stopped out before. Yeah, it was stopped out on December 23rd. I wasn't around on December 23rd, really paying attention to anything there. So the rest of them so far this year have been profitable. There's that SOXL Semiconductor. We hit the first target for 14.3% gain. Walmart hit the sole target for a 9.1% gain. USCR hit its price target for 11% gain. That was a short trade. AMD, that was a long. We hit a final target for a 55% gain. I should clarify, I believe that might have happened over the holidays. So I need to change the date on that. It's the system, whatever day I make the post, it's going to date it that day, and then that puts it in the 2016 categories. I think that trade hit the final target in December, and I believe that's it. Yeah. If I'm not mistaken, unless some of these were short trades that were stopped out or hit a target. I may have made this post. Nope, that's back in December 15. Okay, that's it. So we're up to date, and from here, as I said, I will take a look at a few more individual short trade ideas and a few of the sectors that look to offer the best trading opportunities, long or short, right now. This has been Randy Finney with Right Side of the Chart. Hope